Again, price should not drop below the strong bullish bar's low. And right here, the market forms a bullish pin bar, another strong buy signal. Enter a buy position on the next candle's open. Stop loss, same strategy below the previous strong bullish bar. And once again, boom, the market surges upward, delivering another huge profit opportunity. This is why understanding strong bullish or bearish bars with little to no wicks is a game changer. It gives you an edge, allowing you to ride strong trends with confidence and maximize days. Let's move on because the market never stops creating opportunities. Perfecting the sell setup. I'll walk you through a sell entry example, making sure you grasp every detail with absolute clarity. Take a look at the chart. What stands out? A strong bearish bar with tiny wicks both on the top and bottom. And this tells us that sellers are dominating the market. Now, here's the key insight. Traders are rushing to sell immediately after the previous bar closed. This signals a strong market intention to drive prices lower and continue the bearish trend. So, what's our next move? Simple. We follow the same structured approach as before. Wait for a price pullback. The pullback must not break above the high of the strong bearish bar. Now, check this out. After the strong bearish bar forms, price attempts to rise but fails to break above its high. This confirms that sellers are still in control. This is our valid sell signal. At this moment, traders should immediately enter a sell position on the next candle's open. Now, where do we set our stop loss? Right here, above the high of the strong bearish bar. Why? Because that's the key level where sellers took control. If price breaks above it, the bearish structure is invalid. Boom, the market drops, huge profits. And just like that, the market plunges downward, delivering massive profits to traders who understand how to read strong bearish bars. This strategy is incredibly powerful. It allows you to enter trades with high probability setups, minimal risk, and maximum reward potential. By mastering strong bullish and bearish bars with little to no wicks, you gain a huge edge in the market. Gaps between candle bodies, a powerful market signal. All right, traders, let's talk about one of the most critical price action signals you need to master, gaps between candle bodies. Sometimes you'll notice that a new candle opens above the previous one's close in an uptrend or below the previous close in a downtrend. These gaps are not random, they are highly significant. They signal market urgency, strong momentum, and institutional activity. And today I'll break it down so you can use this to your advantage. Spotting a bullish gap. Look at this chart. When you see a gap like this, your first move is to wait for the gap candle to fully form. If the price continues to push higher and prints a bullish candle, that confirms strong buying pressure. And what do? Simple, enter a buy trade immediately. But hold on, what if the price reverses and prints a bearish candle that engulfs the previous one? That's a completely different scenario. In this case, you're looking at a strong bearish engulfing pattern, signaling a potential market reversal. If that happens, you should be looking for a sell entry instead. Now, in this particular case, the price keeps moving up, forming a strong bullish candle. That confirms the market's intention to continue the uptrend. So what's next? You enter a buy trade at the open of the next candle. Now, where should you place your stop loss? There are two solid options and each had its own advantage. One, conservative stop loss. Place it at the nearest swing low. This gives your trade more room to breathe, reducing the risk of getting stopped out too early. But remember, wider stop equals smaller risk-reward ratio. Two, aggressive stop loss. Place it just below the gap candle. Why? Because if the price drops below that level, it invalidates the bullish setup, signaling a potential reversal. The advantage? A higher risk-reward ratio, perfect for traders looking for efficiency. All right here. See this? A clear bearish gap has formed. And just like before, when you spot a gap like this, the first step is waiting for the next candle to form. Now here's the game plan. If the candle that follows the gap moves downward and forms a bearish candle, that's your signal to enter a sell trade immediately. But if the price reverses and the candle pushes up past the previous one, then that signals a strong bullish engulfing, meaning a buy opportunity instead. In this case, what happened? The price dropped and formed a strong bearish candle, a clear sign that the market is committed to continuing its bearish trend. So the right move? Enter a sell position on the next candle's open and place your stop loss just above the previous candle before the gap. And boom, the price plummets rapidly, locking in massive profits for traders who caught this setup. But we're not done yet. I'm going to show you one more example because mastering gaps between candle bodies is an absolute game changer, and I want you to fully understand this powerful pattern. Spotting another bearish gap. Let's break it down. All right, let's shift even further to the left on the chart. Right here, you can clearly see another bearish gap forming. Now, just like before, when you spot a gap like this, the first thing you need to do is wait for the next candle to form. This step is crucial. Here's the strategy. If the candle that follows the gap moves down and forms a strong bearish candle, that's your go-to signal for an immediate sell entry. The market is showing clear momentum to the downside. But if the price reverses and the candle moves upward, breaking past the previous candle, then we have a strong bullish engulfing pattern, signaling a buy opportunity instead. Now in this case, what actually happened? The price dropped hard, forming a strong bearish candle, a clear confirmation that the market is set to continue its downtrend. So the smart move, enter a sell trade as soon as the next candle opens and place your stop loss right above the last candle before the gap. And just like that, boom, the price tumbles quickly, delivering huge profits for traders who caught this setup. Simple, effective, and incredibly powerful. Once you master gaps between candle bodies, you'll be able to spot and trade these opportunities with confidence. Sideways corrections after a trendline break. What's really happening? All right, let's break this down. You see a trendline breakout, but wait, there's no strong follow through? Instead of price shooting off in one direction, it moves sideways. What does this mean? Let's dive in. When price action stalls after a breakout, it's often because neither bulls nor bears are fully in control. Instead of forming a clear trend, the market oscillates within a horizontal range, creating a sideways movement. Now let's focus on an upward trendline breakout. Here's the key insight. Even though sellers managed to push the price below the trend line, the overall bullish momentum is still strong enough to prevent a deeper decline. As a result, the market consolidates sideways instead of continuing downward. So what's the big takeaway? If price eventually breaks through the resistance level of this sideways range, that's your confirmation of a strong bullish trend resuming, and that's when traders should be ready to act. Let me show you exactly how this plays out on the chart. All right, let's break this down. You see a trendline breakout, but wait, there's no strong follow through? Instead of price shooting off in one direction, it moves sideways. What does this mean? Let's dive in. When price action stalls after a breakout, it's often because neither bulls nor bears are fully in control. Instead of forming a clear trend, the market oscillates within a horizontal range, creating a sideways movement. Now let's focus on an upward trendline breakout. Here's the key insight. Even though sellers managed to push the price below the trend line, the overall bullish momentum is still strong enough to prevent a deeper decline. As a result, the market consolidates sideways instead of continuing downward. So what's the big takeaway? If price eventually breaks through the resistance level of this sideways range, that's your confirmation of a strong bullish trend resuming, and that's when traders should be ready to act. Let me show you exactly how this plays out on the chart. Another powerful buy entry setup. Now check this out. We have a classic breakout scenario. The price has successfully broken above the downward trend line, but here's the twist. It doesn't immediately shoot up. Instead, it moves sideways, and this is a big clue. Why? Because this sideways movement tells us that a massive force is preventing the price from dropping back down. This is often the work of major institutional players, big banks, hedge funds and professional traders. who are holding the market up because they expect prices to go higher. So what's the game plan? Simple. Wait for the price to break above the resistance level of this sideways pattern. That breakout signals the bullish trend is back in full force. The moment that happens, you enter a buy position, placing your stop loss just below the support area of this sideways structure for smart risk management. And guess what happens next? Boom! The price takes off, climbing higher and higher, locking in huge profits. This is why understanding sideways corrections after a trendline break is so powerful. Spotting a high probability sell setup. Take a look at this chart. The price breaks above the downward trend line, but here's the key: it doesn't keep going up. Instead, it stalls and moves sideways. And that right there is a major warning sign. It tells us that the bearish momentum is still strong. The buyers simply don't have enough power to push the price higher, meaning the sellers are still in control. So, what's the game plan? Patience. Wait for the market to break below the support area of this sideways pattern. And when that moment finally comes, boom, the price smashes through support, confirming a strong bearish trend. Even better, the breakout candle is powerful with short wicks on both ends, meaning there's strong downward momentum with no hesitation. That's your entry signal. Open a sell position as soon as the next candle starts forming, with your stop loss placed just above the resistance of this sideways range. And what happens next? The market drops fast and deep, locking in massive profits. Simple, effective, and backed by solid technical and psychological reasoning. This is how you trade with confidence and maximize your profitability. High probability pullback entries, here's how to spot them. Let's break this down. A strong pullback setup means the price retraces temporarily, but follows a high probability candlestick pattern like a pin bar or an engulfing candle. And here's the key. If the trend is strong enough to override this pullback, the breakout that follows is a high confidence trade entry. Now let's look at this chart. It's crystal clear. The market is in a strong bullish trend. You can see two powerful bullish candles followed by a strong bullish pin bar. This is a textbook sign that buyers are fully in control. Then something interesting happens. A bearish pin bar appears, leading into a pullback. But here's what's crucial. The price doesn't drop significantly. Instead, the pullback is weak, confirming that the bullish trend is still dominant. The bears tried to push the price down, but they simply didn't have enough strength. And then the price shoots back up, breaking above the high of that bearish pin bar. This is our confirmation. The uptrend is resuming. So what's the right move here? Enter a buy position at the start of the next candle with a stop loss placed just below the most recent swing low. And boom, the price surges higher, delivering massive profit. I hope this example makes it crystal clear, but to make sure you truly master this concept, let's now break down a sell signal example. Alright, let's break this down step by step. Looking at this chart, we can see something crystal clear. The market is in a strong trend. You can spot a dominant bearish candle followed by a powerful bearish engulfing pattern. This setup alone is a strong indication that sellers are in full control. Then, the market throws a curveball. A strong bullish engulfing pattern appears, signaling that buyers are trying to reverse the trend. And at first, it looks like they might pull it off. A bullish candle forms right after, seemingly confirming the reversal. But here's the twist. The price fails to push higher. This is a huge red flag for the bulls and a clear sign that the bearish trend is still dominant. The buyers couldn't sustain momentum, and instead the price starts dropping lower, breaking below the low of that bullish engulfing pattern. And that right there, that's our signal. This breakdown confirms that the downtrend is back in full force. So what's the play? Enter a sell position on the next candle's open with a stop loss placed just above the nearest swing high. And then, boom, the price drops aggressively, delivering massive profits. By now, you should have a solid understanding of how this works. But we're not stopping here. Let's jump straight into the next powerful pattern. The ultimate breakout signal. This is what you need to see. Now let's talk about one of the most powerful signals in trading, the breakout bar with a strong body and minimal wick. Here's the deal. When price approaches a major support or resistance level, it often struggles for a while, but once the market builds enough momentum, a strong breakout candle smashes through, leaving no doubt that the trend is set to continue. The key? A large-bodied candle with little to no wick. This is a sign of pure market strength, whether it's bullish or bearish. Now let's look at a real example. A few days ago, if you had already mastered this technique, you would have caught an insanely profitable move because the bullish trend continued all the way up until today, right when I'm recording this video. Check this out. The market was clearly in a bullish trend, but then it pulled back, forming a resistance area. And right here, this breakout bar appears. Huge body, tiny wick, breaking straight through resistance. So what's the play? The moment you see a bullish breakout bar with a strong body and small wick, you should immediately enter a buy position on the next candle's open. And of course, set your stop loss at the nearest swing low to manage risk properly. And the result? Boom, the price exploded upward, fast and strong, exactly as expected. This is a high probability setup, and if you apply it correctly, it can lead to some incredible trading opportunities. Let's keep going. Alright traders, let's break down an incredibly powerful sell signal that you need to master. Right here, we can clearly see that the market is in a strong bearish trend. Then we get a pullback right here and here. But what we really want to focus on is this support area. And check this out. Boom, a breakout bar forms with a large body and a tiny wick breaking straight through that support level. Now, when you see this exact setup, a bearish breakout bar with a strong body and almost no wick, you should immediately enter a sell position on the next candle's open. And of course, set your stop loss at the nearest swing high to protect your trade. Now, is this signal alone enough? Yes, absolutely. This is already a high probability sell setup. But wait, let me show you why this signal is even more special. Look right here. This strong bearish engulfing candle formed after the price rejected resistance at this level. So what does that mean? It means this bearish breakout bar with its big body and small wick isn't just any sell signal, it's a super high probability sell signal. And what happened next? The price dropped fast and deep. No hesitation, no second guessing, just a clean, powerful bearish move. This is exactly the kind of setup you need to master if you want to trade successfully. Master these 8 price action signals and take your trading to the next level. Now you've got a solid grasp of the 8 key price action signals that help you spot strong trends and identify high probability trade entries with confidence. But we're not stopping here. To truly master these strategies, I highly recommend watching this video, the mother of all price actions. Why? Because when you combine everything you've just learned with the advanced concepts in that video, you'll gain a complete understanding of how to read market movements with precision. Let's keep learning and crushing the markets together. What's up everyone? Welcome back to Trader DNA. Today I'm about to blow your mind with the ultimate beginner's guide to the break and retest strategy. And trust me, this is a game changer. This strategy is insane. It's one of the most popular trading strategies in the world, and for good reason. If you've been struggling to figure out how to trade, this is what you've been waiting for. But wait, there's a catch. It only works if you do it with laser focus and discipline. No discipline, no gains. Simple as that. So stay tuned, because I'm about to give you the step-by-step blueprint to crush it in the markets. Let's get started. The very first thing you need to know about the break and retest strategy is the foundation of market structure. And guess what? It's built on 3 simple phases: an uptrend, a downtrend, and a sideways moving market. These are the basic building blocks of trading. If you don't know this, you're already falling behind. So pay attention. Here's where it gets tricky. The way these phases appear in the market, it's all over the place. Sometimes it's super obvious, other times it's sneaky. That's why it's crazy important to learn the different patterns and movements you're going to see with this strategy. Recognizing these variations is the biggest key to crushing it with the break and retest method. Now, let's break down an uptrend. What usually happens is the market pushes up, pulls back a little, and then boom, it climbs even higher. Then it repeats. Pull back, push up, pull back, push up. It's like the market is climbing a staircase. Super satisfying, right? But wait, here's the catch. In a perfect world, the market would always look this clean and predictable, but that's not reality. Sometimes it'll push up, pull back, and then nothing. It just stalls. Then it pulls back again, and only later does it decide to go higher. This back and forth, unpredictable movement happens a lot more than we'd like, and it can seriously throw you off if you're not ready for it. That's why you have to understand the difference between clean, smooth market behavior and messy, unpredictable patterns. Spotting these differences is crucial if you want to make the right trading decisions and avoid getting caught in the chaos. And here's the bottom line. With the break and retest strategy, your main focus is on finding clean price action. That's where the magic happens. Clean, structured movements make it so much easier to trade confidently and make smart, profitable decisions. The next big step in mastering the break and retest strategy is learning how to monitor price when it breaks above a previous structural high. This is where the magic happens. So pay close attention because this is fundamental to understanding trends and how the market works. Alright, imagine the market is pushing upward and breaks past a previous structural high. Then that becomes your new structural high. But wait, you can't just jump into the market the second it happens. That's a rookie mistake. What you're looking for is clear proof that a trend is forming. And how do we get that proof? By waiting for price to break above the structure, come back down for a retest, and then continue to the upside. This is the key sequence that makes this strategy powerful. Now, today we're going to focus on how to spot the best trading opportunities at these break and retest levels. For example, in a downtrend, you'll want to look for clean market structure showing a clear downward movement. Watch for price to break below a previous structural low, come back to retest that level, and then continue its downward momentum. The same logic applies to an uptrend. You're waiting for price to break above a structural high, retest it, and then push even higher. These moments are golden for spotting high probability trades. And here's the cool part. We'll break down the exact patterns you need to look for later in this video. Now here's something you need to know. The market creates structure with higher highs and higher lows in an uptrend and lower lows and lower highs in a downtrend. This is the basic building block of price action. Most of you might already know this, so I won't go too deep into it. But if you're new to these terms, don't worry, I'll simplify it for you. There's something super important you absolutely need to understand if you want to succeed in trading. The only markets you should ever trade are the ones with a clear direction, either pushing to the upside in an uptrend or to the downside in a downtrend. These are the golden moments where your trades have the highest chance of success. But if the market is moving sideways, if it's stuck in a boring consolidation or a tight range and you can't spot a clear trend, here's what you do. Nothing. Yeah, you heard me. Do nothing. Don't trade it. Don't force it. Why? Because trading the market without a clear directional bias is just asking for trouble. Now, here's the mistake so many traders make. They start creating stories in their heads about where the market might go. Stop doing that. That habit leads to all kinds of bad decisions, like taking low-quality trades, losing money you didn't need to lose, and chasing setups that just aren't there. And you know what that leads to? Frustration, losses, and worst of all, bad habits that can wreck your trading. So here's the bottom line. If the market is moving sideways, do not trade. I mean it. Stay out. Only trade when you see a clear, undeniable trend, either up or down. This discipline is what separates the successful traders who crush it in the long run from the ones who consistently blow their accounts. Stay focused and trade smart. The next big thing you absolutely need to understand is the different phases of the market. Why? Because these phases are the roadmap to spotting the best trading opportunities. So here's the game plan. We're going to focus on identifying what's called the exhaustion phase, then recognizing the exact patterns we need to spot, and finally entering trades in sync with the trend, whether it's moving up or down. And when we do this, we enter what's known as the continuation phase, aka where the magic happens. Now, when the market is trending up and making those big, beautiful pushes to the upside, that's what we call a continuation. It's the market moving with the trend, climbing higher and higher, and giving you those amazing opportunities to ride the momentum. But when the market starts pulling back, when it takes a breather or dips temporarily against the trend, that's the exhaustion phase. And this phase is critical. Why? Because this is where the market gathers energy for its next big move up. Here's the deal. Your job as a trader is to spot these exhaustion phases and know exactly when they're ending. And guess what? Once the market shows those clear signs that the exhaustion is over, boom, you're going to jump in on the continuation. But wait, you can't just dive in blindly. You'll need to recognize the specific patterns we're covering in today's session. Once you see those patterns, that's your signal to enter the trade and ride the trend to the upside like a pro. Now, the same rules apply when the market is trending down. When it's pushing lower and making consistent moves down, creating those lower lows and lower highs, that is your continuation phase in a downtrend. But when it starts pulling back against the trend, when it pauses and moves slightly higher for a bit, that's your exhaustion phase. And this is where the action happens. You want to look for the patterns we're discussing today, wait for the exhaustion to finish, and then take your trades as the market resumes its downward momentum. So, to wrap it up, your mission is to master the difference between the exhaustion phase and the continuation phase. Once you understand how to spot these phases and the patterns that come with them, you'll have everything you need to time your trades like a pro. Whether the market's trending up or down, you'll know exactly what to do and when to do it. Let's get into it. In the simplest terms, what you're going to be focusing on is spotting that exhaustion phase. Why? Because once you spot it, you can stay ahead of the game and start trading with the trend when it kicks into that continuation phase, the phase where the market pushes forward again. This is where you'll find your trading opportunities and ride the trend to make some serious gains. Now, let's dive into 2 key patterns you need to be looking for as part of this break and retest strategy. These are the patterns that will help you trade in sync with the trend, whether the market is pushing up or down. Quick recap. You're looking for the market to pull back, create an exhaustion phase, and then look for the perfect moment to enter after it shows a retest of the previous structure. That's when you can take the trade and get on board with the trend. Once the market shows you that the exhaustion phase is complete and it's time for a retest, that's when you jump in. You're going to ride that next move in line with the trend, entering the push phase as the market continues to move down if it's a downtrend. This is how you lock in your profits, by riding that continuation after the exhaustion. Now, when the market is pushing to the upside, you're going to wait for a break above the previous structure, followed by a retest at that level. When the market pulls back and hits that exhaustion phase, you'll see the patterns we're talking about today. Then you'll take your position and trade in the direction of the trend, waiting for that push phase to continue moving up. But, and this is key, if the market starts moving sideways and you don't see a clear direction, whether up or down, then you do not want to trade. Sideways markets are the ones that'll throw you off, leading to confusion and losses. You need clear trends to make this break and retest strategy work, so stay out of the sideways action. Alright guys, here we go. Pattern number 1. Let's jump right in. First things first, take a close look at this part of the chart. Now what we're doing here is zooming in on this specific zone, and you can see it, right? Boom! We've got a big strong push to the downside. But wait, where's this coming from? This move is happening right after an uptrend, which means the market was climbing higher before this pullback. But now, as it dips back down, we call this phase the exhaustion phase. Now, what does that mean in simple terms? It's like the market is hitting the pause button. It's just taking a quick breather, slowing down after a big push upward. Don't overcomplicate it. Don't go into a deep dive about why it's happening. Instead, laser focus on what really matters. The patterns. In this exhaustion phase, you'll see strong bearish candles, those red ones, pushing lower but still respecting the overall trend, which is up.